Welcome to the People, Property, Place podcast with me, your host, Matthew Watts, founder and managing director of Rockborn. This is a podcast where I share the stories, views, opinions, and career journeys of the movers, shakers, innovators, and leaders in the real estate industry. Welcome to the People, Property, Place podcast. Today we're joined by Jon Strang, Managing Director of Blackbrook Capital. Blackbrook Capital is a specialist real estate investment firm focused on future-proof supply chain infrastructure across Europe. The team behind Blackbrook has a combined real estate investment track record of deploying over 20 billion euros in more than 20 countries across Europe and North America. Blackbrook Capital is a partnership between its chairman, CEO, and Eldridge, who provide the capital. You may have heard of them, as they're also behind other successful real estate businesses such as Kane International, Portwell Capital, and Kennedy Wilson. Jon, welcome to the podcast.
Thanks for having me.
No, not at all. Well, thanks so much for coming in here. So a question I like to ask everyone is how you get into real estate or how you got into real estate. But I guess before that, can you tell me how you selected the university you joined and the rationale behind the course you selected as well?
Yeah, sure. I mean, when I was younger, and what interested me, I was a bit of a geek at school. You know, real estate was not even close to anything I was thinking about or interested at the time. You know, growing up on my bedside table, for example, there was a book about aeronautical engineering. As a 16-year-old boy, you know, I've been, reading that before going to bed about how, various turbine engines work and, the theory of flight. That's really what made me tick. So, the natural, and at school, maths and science was just, it really fascinated me. Maybe it was the teachers that I had at the time or the friends that I was hanging out with. So the natural progression for me was, looking for an education in engineering. I thought, what really interested me was how things work, how things tick. So yeah, I mean, I going to our kind of, careers consultant at school, and they kind of laid out all the various universities. What I knew is that I wanted to leave Scotland. Obviously education in Scotland is free, higher education, which is also, obviously very appealing, but we have, great student debt available to all, UK, all people living in the UK. So it felt too good an offer not to take up. And I had quite high ambitions and I wanted to go to the best of the best. And that's why I applied to go to Oxford University. Never in a million years did I actually think I was going to get in. Neither of my parents went to university, not no one in my family, well, my sister did, but apart from that, no one else had a history of that. So I went with incredibly low expectations, whereas a lot of my friends who I met at Oxford had very high expectations. A lot of their family members went, and therefore there was a huge amount of stress on them. But for me, everything was just kind of like a bonus. So that's kind of where, how I ended up at Oxford. Very rigorous kind of selection process there. And when I got there, I just, the whole interview process I found just incredibly fun. It was, finally someone I was speaking to was as interested in things that I was interested about, and we could just have a normal conversation about it. And lo and behold, that led to an offer. So, and my parents were like, obviously have to take that. And there was, didn't need to convince me.
And what course was that you landed on?
Yeah, so they call it engineering science, so basically at most UK universities, if you want to do engineering, you apply from the outset for a specific type of engineering. So be it civil, chemical, electrical, so on and so forth. Whereas at Oxford, I think it's also the same at Cambridge, weirdly enough. The two universities seem to kind of mimic one another in a lot of ways. You apply for general engineering, call it engineering science, but effectively it's general engineering. So the first 2 years, everyone in the course is the same modules. It's a broad-based approach. And then in years 3 and 4, you specialize. That was also something that appealed to me as well about the course, is that I didn't really know what I wanted to do. Whilst, my bedside table, I mentioned the books about aeronautical engineering. I also read books about chemical engineering and civil engineering, and just generally books about how things work. So, I just wanted to kind of go with an open mind, see what piqued my interest. And actually, when I came to my second year and ended up specializing, I did a bit of a mishmash, actually. So I did a mixture of chemical and biomedical engineering. And I think the reason why that was, which is because who was teaching us what, and Oxford has a specialty in biomedical engineering. A lot of the stuff they were doing about, either artificially creating organs to transplant into people's bodies, drug delivery into the brain, all these things that you think are more kind of in the remit of biologists or maybe even a chemist. There were engineering aspects to it that hence, biomedical engineering. So that was kind of what pulled me in there, and ultimately culminated in like a final year thesis, which, God, I can't even remember what the title of it was, but it was something to do with like stem cell growth. And we were trying to basically create environments where you could get a stem cell to grow into like a certain shape. Obviously, like incredibly basic shapes, can you get it into like 2D, a circle or whatever? The ultimate goal being making it into an incredibly complex shape, like a heart or a lung or whatever.
Yeah. So at what stage did you start thinking about your career post university? When did that come into?
I mean, pretty late on. It's funny because now you speak to university students, and, me and my job, the university students I speak to, are obviously applying to roles that we're advertising for, and they've done, things whilst at school, then spring weeks, and then summer internships, and then, a million different things. And they come with like, their CV is like 3 pages long, and it's all relevant experience. You're like, oh my God. And if I think about what I was doing, I mean, first of all, I was just messing around and enjoying myself in the summers. I was going on holiday. I like the outdoors, cycling, canoeing, kayaking, walking. So I was just kind of doing, and also had I knew that my days were numbered and doing these types of things, looking at my parents, and, you get like 4 or 5 weeks of holiday. You're like, I have to take advantage of that. So basically very late on, coming to the end of my third year, I was like, oh my God, I actually have to do something about it now. A lot of my friends had already banked a bunch of internships. I was still of the opinion at the time that I wanted to be some kind of an engineer. So I had I had a friend actually who worked at BP at the time in London as a petroleum engineer. It seemed kind of exciting. He was, working on, I think, oil field in Iraq, 6 weeks on, 6 weeks off. It seemed like good money and quite interesting. And so I applied for an internship there, got it, and did a summer in a place called Sunbury. So it's not quite London. It's, I suppose it's Surrey, I guess. You take a train out from Clapham Junction, half an hour. They have a big campus down there, and spent 12 weeks working there, interning on the petroleum. Yeah, actually in the Iraq division as well with my friend. He was like 2 years ahead of me. And I just came away from that just feeling a little bit disheartened, I have to say. Anyone listening to this would probably think, oh, you probably had some sort of foresight that sector is in structural decline. And the funny thing is, actually, I didn't. It wasn't what I was thinking at all, even though it's such an obvious thing to think now. At the time, I just thought this is not a particularly dynamic environment. It felt a little bit like, I don't mean anything bad by this, if anyone's parents work at BP, it felt like a bit like a retirement home. And, it just a bit slow moving, and, everything was very procedural, and there was no, people had already figured out how to, drill these wells, optimize these wells. There was software that kind of did a lot of the thinking for you. So there wasn't much room for thinking outside the box. So I came back from that summer at the end of my third year, just like back to the drawing board basically, and I have no idea what I want to do. I'd already ruled out academia because whilst I really enjoyed the topics, a lot of the lab work I was doing and my thesis at the time, again, I just found, the overall concepts are interesting, and you make a breakthrough in science, and that's incredible. But like, actually, if you look at what the day-to-day looks like, it's, designing an experiment, doing an experiment, analyzing the results of the experiment, writing up the paper. And again, just felt quite tedious and slow moving. And what I learned was what I yearned for. It's just like fast moving environment. I wanted to be at the coalface, doing new things and working with like really ambitious people as well. And so it was a bit of a cop out, actually. I just thought, okay, well, what do most people seem to do when they leave Oxford? And this, I'll become a lawyer, a doctor, or a banker. So okay, maybe I'll be a banker then,
or a politician.
Yeah, or a politician. Actually, I wasn't cut from that cloth. Unfortunately, I don't have the gift of the gab, and I don't actually care for politics too much. So it was, so banking it was, and I applied. As I mentioned earlier, there's this whole process, the spring week, summer internship. I'd missed all of that. So I had applied for actually an off-cycle internship, which weirdly enough is highly subscribed by the European schools because they seem to do things a bit differently. And I got it. It was after I finished Oxford. So I ended up taking a bit of a gap here and went traveling, came back, did this. I think it was in spring. It was maybe February for 3 months. And I worked in the investment banking division at JP Morgan, specifically to either kind of product or sector coverage. So like, ECM, DCM, equity capital markets, debt capital markets, M&A, or like a sector coverage. And because of my technical background, they put me in sector coverage, which made sense. So I covered industrial companies and also metal and mining companies and natural resource oil and gas. Did that and really liked it. I mean, I worked like an absolute dog. I think my first week of my internship, I was into like 4 a.m. every night. I remember thinking like, this is great. Like, finally, like I'm working on something super important and like relevant, and like it's just so important that it required you to be up all day every day. Now, obviously, it was a bit cheated, I think, at the time.
A bit obsessive?
Yeah, I think so. But I think just being in an environment where everyone is like really pushing themselves was quite inspiring to kind of be the best you can be, as corny as that sounds. So that really got me going. Also, there was some weird kind of thing about putting on a suit every day and going into the city and feeling important as well. There was definitely an element to there. And so I finished the internship there. They offered me a job to start basically immediately after, and I rolled into it. And that was it. I was in finance, and I kind of just made it mind, this is where I want to be. And that was kind of my gateway into real estate. Obviously, I wasn't in real estate, but that's kind of the start of the story. It kind of goes on a bit longer. If you want me to keep going.
But so you spent a couple of years there, and did you get exposure to real estate while you were at JP Morgan? Is that what?
No, I mean, I knew who the real estate team was. I could look across the floor and there they were, but I was sitting at my desk doing my thing and they were over there doing their thing. And at no point did it come to my mind that, oh, maybe I want to see what they're doing or try that. The whole real estate thing happened by chance, basically. As I got further into my career at JP, I did start to get a bit disenfranchised with the whole thing. The culture, I think what lured me at the start it was a bit of a double-edged sword, and it just wasn't sustainable working those hours. They ship all the new grads up to New York for like 3 months they call it training, but it's really just a bit of a jolly. They give you a little salary, but a little stipend. You do like 9 to 5 training on the basics of financial modeling, markets, all that stuff. And there, we had this talk from a very senior M&A banker in the US, a guy called Jimmy Lee, who funnily enough actually died a couple of years ago. And he's like a complete rainmaker, like very, very famous M&A banker. And he got up and gave like this talk about how to be successful in banking. And then basically what it boiled down to is Jimmy's 10 principles. And the first 4 were things like work harder, never see your family, don't see your friends. And he like went to the effort of like, maybe he did, but his assistant did like laminated a card to hand out these 10 things. Then everyone gave him like a standing ovation at the end. And I was like, what is going on? Like, this is really weird. Like, obviously we're here to work hard and be ambitious, but like there are limits to these things, right? Like, we are humans and it's not all about money and all that kind of stuff.
Sacrificing my family.
Yeah. So that was kind of the first thing. I was like, hey, wait a minute, this is weird. And then, I got back from New York and got back on the desk. It was just kind of more of that. And it just wore me down. And I was just kind of like a husk of a person at the end of it. And I was already interviewing with a bunch of places. Most people who get into banking, not everyone, a lot of people go in as a stepping stone, especially M&A, stepping stone into private equity. And so if you're good and you're rated well from your first year, you're going to get calls from headhunters saying, do you want to interview you in there? And most of it was for like corporate private equity. So I started that from my first year, and I was interviewing at places like mostly like mid-cap and large-cap buyout funds. And even there, when I was interviewing at those places, I'll give you an example. There was this one interview I went to, I won't name the firm, but it was a mid-cap PE shop. And I went in and I did the interview. I thought it went well. At the end of the interview, the guy said to me, how hard do you work at JP? And I told him, I think I was saying like 80 or 90 hours a week, what I was doing at the time. And he was like, okay, good. Well, can you work harder than that? I was like, yeah. And then he was like, because you're going to when you come here. I just thought it was like also like a very weird thing to say. He kind of like bent over the table. It was like, he made like a point. Like he was like really emphasizing. It was like, okay, maybe this isn't for me, this whole sector. Like it's not what I thought it was going to be. And right when I was kind of thinking, what do I do next? I had this one call from this headhunter who I'd never spoken to before. And he's like, he introduced this opportunity, which was this real estate fund. And these 2 guys basically who had just threw all these names at me. I didn't know what any of these things meant, like the WP Carey and blah, blah, blah. I was like, okay, what is the job? So there's 2 guys who just launched this new fund. And it's real estate, but it's, a credit focused type of real estate investing. So, okay, tell me more. He says, they call it Net Lease. Basically, you're investing in quote unquote mission critical real estate, but ultimately you're underwriting the credit and the income stream and this credit first real estate sector. I was like, okay, that sounds interesting. And I went and met with the guys, and it wasn't the real estate that interested me. It was just the people. Like, and the two guys, a guy called Alistair Calvert and a guy called Mike Heel. Alistair actually still works at the company. Mike also went and worked somewhere else. But like, I just got on with them. Like, it felt like a good cultural fit. It just felt like the right place to be. And literally, I think a week later, they made me an offer. I was in my managing director's office handing my resignation. Like, at no point did I think, do I want to be in real estate? Does this interest me? Something just felt right about the opportunity, the people. I guess there was a little bit of crossover in the credit element because my background was more credit, no real estate. I just thought, okay, I can learn the real estate. It was a new company, very small. There's just these two guys. I think there was a CFO, an assistant, and an asset manager. So 5, I'd be employee number 6. It just seemed very entrepreneurial, getting out the ground floor and roll up your sleeves and learn on the go. And that was it.
You've gone from JP Morgan, like massive global international bank, to a tiny startup. Did that even cross your mind from a cultural perspective?
No, I think, you got to try different things. You don't know until you try. And what I did know is that I wasn't fitting at JP. It is a huge organization. I think it's like 80,000 people. That includes a retail bank as well. What it became clear is to do well in an organization like that is incredibly political. It's not just about like what you know and potentially also who you know. It's also like how you play the game. It really is a game. I just didn't care for that at all. So I think what I thought at the time was, how can there be such politics in a small organization? That sounds good. I also hated the hierarchical structure of JP because I was an analyst, then there was an associate, then there was a VP, then there was an executive director, then an MD, then probably some sort of like chairman as well of like the whole investment bank. And you would do like a pitch deck, and it would start the two guys at the bottom, it goes to the VP, then back down again, and up to the ED, then back down again. You end up doing this like 20 times. I was like, this is just ridiculous and just not a good use of everyone's time. So I thought a flat structure with no politics, like, also you get, as a young employee, you get a lot more responsibility. I thought, this sounds like a bit of me. And I was also just willing to take a risk as well at that point in time because, if I cast my mind back to where I was mentally at that time, I really was checked out. I was spent because, if you're doing 80, 90, even 100 hours a week, and we had the thing where you logged your hours, it was called intensity, which was kind of a cruel name, I guess. You just gotta log your hours and say what you were doing and actually download the Excel and see it. I was averaging, on average, like 85 hours a week. And if you actually sit and think and, okay, how do you actually work 85 hours in a week? Very quickly, you see that's, 9 till midnight, 1 a.m., Monday to Friday, and then a good 8-hour shift or something on both on a Saturday or Sunday. So there's just no time for yourself. No amount of money is worth that, I think, in my opinion. Obviously, each to their own. If you want to go and do that and that's your MO, fair play to you, but that just wasn't my MO. It took me time to realize that.
Joining a very small but probably very well capitalized startup in the real estate space at that time, was there an expectation to work some pretty chunky hours as well? Or were the hours more like 60, 70 rather than 80 to 100?
You know what? We never really spoke about hours when I was doing the interview, but because it was just so much more of an efficient organization without the layers. You cut down on those 89 hours at JP are not effective hours. A lot of it's bureaucracy and just kind of your associate guessing what the VP wants, getting it wrong, then having to do the work twice and then 3 times and 4 times. So I was just doubling down. With a small organization, people have more time for you. You can just kind of sit down and get to the brief and really kind of get it right first time or second time. So, obviously we worked hard, like everyone in the industry does. But it was also just much more rewarding because I was working with the founders of the company. They were also imparting huge amounts of knowledge on me. So it was like a two-way thing. Obviously, I'm giving them my time and assisting them on their deals, and they're giving me, well, first of all, enjoyment and happiness, but also huge amounts of knowledge and skills. So it was, I don't know how hard I worked. I'm sure I worked quite hard, but, it just, like JP, the thing that pops out in my mind when I think about it is how hard I worked. I think about my first days, and the company was called Gramercy, by the way, at the time. It's called something else now. I don't know. But I don't think I probably worked quite hard, but it doesn't feel like I worked that hard.
Yeah, sure. So what deals were you working on at that stage, and what did your kind of career look like in kind of the early and mid part of that journey?
Yeah, so the strategy of the fund when I joined it. So basically, to contextualize it all, this was 2008. end of 2014, beginning of 2015. And, Europe had been in a low rate environment since, the end of the financial crisis, call that 7-8 years, like basically yield starved. And they had, basically net lease as a product. You were typically not buying the shiniest, best kit, or even having, taking investment grade tenant. You're taking on risk to get yield effectively. So either you were going into the boonies in the middle of nowhere, like in deepest, darkest Germany, on like weird, scary real estate, and with, if the company was rated, it certainly wouldn't be an investment grade, it'd be a single B or a double B type credit profile. So you had to really kind of roll up your sleeves and like figure out like what the risks were and was the return commensurate for that. But the strategy was to build up a portfolio of this and then ultimately list it on the stock exchange, because we thought, well, logistics, or maybe at the time, actually, flat enough, logistics wasn't so much an asset class, but say office was, retail was, various different types of properties were really, asset classes in and of themselves, but like income wasn't really covered that well as an asset class, which just seemed really bizarre. So we thought, okay, let's create this vehicle and list it. And, you're buying stuff at 6, 7, 8%, the low interest rate environment, you could finance it at 2%. So you were doing like low double digit cash on cash returns. The market probably only wanted 6, 7, 8% cash on cash returns. So like you could almost like double your money if you listed it. So that's what we went and did. We were basically the reason why the company's called Gramercy Europe was the cornerstone investor was this company called Gramercy Property Trust in the US. This all comes a bit full circle later. The CEO of that company is Gordon Dugan, who used to be the CEO of W.P. Carey. My old boss also used to be the European head of W.P. Carey. It gets a little bit confusing. And so he had basically bought out Alistair and Mike's company, renamed it Gramercy Europe, was the cornerstone. That fund brought in a bunch of hedge funds because it was kind of a special sits type play. It was kind of a build and flip. And so I think we had 3 or 4 hedge funds, about 350 million euros. And basically it was like, how quickly can we build this portfolio? Pan-European, the only criteria were a single tenant long let. It was going to be primarily industrial logistics, not because industrial logistics was a hot asset class back then, even though this is only 8 years ago now. It was because it was the highest yielding. Office was 4 or 5%, good retail was 4 or 5%, logistics was 7, 8%. So it's like,
let's go for that.
Yeah, let's do that. And it was critical real estate. So like the tenants needed it. If you got your underwriting right, they wouldn't leave. Obviously, some would, but on a percentage basis, 90% of the time they don't leave. So it was yieldy. You could still finance it at 2%, and it was sticky income, and it was long income. So it was like, this is great. A lot of what it was sale leasebacks. Obviously, W.P. Carey. People don't really know this, but Bill Carey actually invented the sale leaseback. Bill Carey is the guy who founded W.P. Carey in like the 60s or the 70s, I want to say, which is like weird to think about. So a lot of what we're doing were like sale leaseback. So we would source this deal through broker networks or whatever, bid on it, win exclusivity. The first thing you'd be doing is getting on a plane to meet management, because you're not like underwriting Siemens or like, like Schneider Electric, these big, massive global companies with public accounts where you just troves of information. It was small and Mittelstand companies, mid-market, family-owned, typically decent kind of 100, 200 million euro revenue companies, but they've got audited accounts, but there's no notes in them. So like you get on a plane and you spend 2 days with them, just tell me about your business and really get into the detail. And a lot of the time, even though I was like the most junior person on the team, I'd go by myself, which I find like amazing. Like my boss just gave me so much of free reign just to kind of go and do it and make mistakes. And of course, I made so many mistakes, but that's how you learn. I don't think you learn through success. I think you learn through failure.
So you were on a plane regularly going out to look at all these deals?
Yeah, it would be like a once a week or once every 2 weeks. Actually, funnily enough, the first business trip I ever had, I missed the plane. It's the only time I ever missed a plane, and my boss was waiting for me in Heathrow at the gate. He's like, "Where are you?" I got up super early. It was like my second week on the job. I was like, when you wake up and like you have like a nightmare that you missed your plane. I had that. I got up like 3. I was like, well, I'm up now. I may as well just go to the airport. So I got showered, got changed, and got the Heathrow Express, got to Heathrow. And as I got on the Heathrow Express, I realized I'd forgot my passport, but it doesn't stop. So you go all the way to Heathrow. I had to go all the way back again, back to my flat, and I missed it by like 2 minutes. And I was gutted. I had to call my boss and say, I literally just started working there like a week ago. I was like, yeah, by the way, you're going back yourself. But I think the next one I did, I think we flew out to the Netherlands where doing this. We were doing a sales with this Dutch logistics company, and was it like Utrecht or something like that? And I was on my own. Guy didn't speak very good English. Just incredibly challenging, very very challenging. But yeah, lots of travel, lots of exposure. Yeah, it was just good.
And so Gramercy Europe changed to Clarion Gramercy.
Yeah,
2017.
Yeah, so
what happened with the change there?
So what had happened was we built this portfolio. It was about €1 billion. Took us about 3 years. At that point, we started as a company of about 5 or 6. We were about a company of 15 towards the end of it. The fund was fully invested. We were looking to list it, but at the time we did a dual track process where we were scoping out also private sales as well. And turns out the private market was valuing it a lot better. So we went down that route. We sold to AXA, and it was, that was at the time where logistics was really picking up. That was 2017. And so we had bought 80% logistics and industrial, 20% kind of more obscure asset classes. We had like some car dealerships, DIY retail. And so basically they paid us a crap ton for the logistics and probably not so much for the rest. Everyone made good money. And
through bonuses or promote?
Yeah, through promote. Yeah, and that was also one of the appealing things about joining a small company as a junior, is that,
they cut you in on that.
Yeah, exactly. They want to incentivize you. There's less of a hierarchy in terms of the pay structure as well, so you can kind of get into the promote pool earlier on. So everyone did incredibly well from that. At the same time, our parent company, Gramercy Property Trust, was getting bought out by Blackstone. So Gramercy Property Trust was a big public company. They were about $8 or $9 billion at the time, and Blackstone was taking them private. I had basically in my mind was, well, I'm about to become a Blackstone employee. I've just made a bit of money. Don't want to be a Blackstone employee. Maybe I'll go traveling. So I actually kind of jumped ship at that point.
Why didn't you want to join Blackstone?
I think it was, I'd been really vindicated by the small enterprise strategy. Different people work well in different organizations, but I had we spoke about earlier, like, how did you feel about joining a small company? At that point, I was like, small companies are for me. Like, this is where I do well. I finally felt like I was where I was meant to be. But what I knew is that nothing against Blackstone. They're an incredible organization. What they do, I mean, they are the most prominent investor in pretty much all private asset classes worldwide. Biggest PE shop in the world. Like, all but respect for them. I just knew that wasn't an organization that I would do well in. So I kind of pulled the ripcord at that point. And I also just had a bit of an itch to go traveling. And so I went and did that for a year. And lo and behold, by the time I came back from my travels, the guys at Gramercy, or what was called Gramercy, had MBO'd from Blackstone. So they bought it back. So when I came back, I was like, can I come back again? And they were like, yeah, sure. So I rejoined. And at that point, we were Gramercy Europe. We never actually changed names. But actually a month later, I didn't know this when I got back, but there were discussions with this big investor called Clarion Partners out in the US, who are, I think, certainly top 5 institutional real estate investors in the US, which is amazing because I'd never heard of them, like never ever heard of them. So they were looking to buy a European investment manager. They didn't want to build a business, they just wanted to buy a business. Track record looked pretty good at Gramercy because of what we did with the AXA sale. And the fund one, I think, went pretty well as well. And they just raised a third fund off the back of that second fund. So they bought that business. And 2 months into my rejoining, we became Clarion Partners Europe, something like, I think we were Clarion Gramercy, and then they just became Clarion Partners Europe, and that's what they are now. And so, I worked there for another year and a half, quite happily. But that's when the Blackbrook opportunity came up. I was very happy within the kind of that new enterprise, but it was more just the draw of the new opportunity as opposed to being pushed from where I was.
So what happened with Blackbrook, and how did that come about?
Yeah, so the connection there, referring back to the previous part of the conversation, is the old CEO of Gramercy Property Trust, guy called Gordon Dugan. He left kind of the whole Gramercy system when the Blackstone buyout happened, and he was kind of hanging out doing his own thing for a while. And then he had linked up with a guy called Arvi Luoma, who's the CEO of Blackbrook, my boss, to start this new thing, Blackbrook. Arvi had been the European head of WP Carey, as had my old boss as well. And so Gordon and Arvi knew each other very, very well from their time there. And so the thinking was to set up effectively a net lease style, and I say style, it's not quite what we do, investor in Europe, run by Europeans, headquartered in Europe, as opposed to being effectively a satellite office, which most of the net lease investors in Europe actually are. In WP carry maybe $10-15 billion of AUM, of which maybe it's even more than that. Like a small percentage of that is in Europe. You look at guys like LCN, big in the US, headquartered in the US, obviously have a European presence, and so things like guys like Angelo Gordon, etc.
You may have touched on it earlier, but for people who don't know what net lease is, can you just explain that?
Yeah, so net lease is effectively a type of investing, always through real estate, characterized by effectively triple net leases. So when we say triple net, it's net of taxes, net of insurance, and net of all OPEX and CapEx. So effectively, and typically they're single let assets and they're long let. So from an asset management perspective, there's very little to do, but what it provides you is long-term, incredibly predictable cash flow. That's the real power of it, is I can tell you what my cash flow is going to be in year 1, year 2, year 3, year 4, and so on and so forth. And obviously, they're incredibly binary assets. When you buy something single tenant, the tenant either stays or they leave. So it's a 0 or 1, but it works on a diversification principle in that, net lease doesn't work particularly well if I want to buy 1, 2, or 3 assets. It works really well if I want to buy 1,000 assets. Because, like I said earlier, some of your underwriting won't be correct. Like, we deal in probabilities. I can't predict the future. So I don't know how the circumstances of the businesses change over time. So if, 10%, 5% leave, I've got, 900 other properties that are fine. And, hopefully you're buying decent enough stuff where you can reposition them.
Yeah.
It's not always just handing the keys back to the bank. So that's kind of the idea of it, is pure kind of cash flow and predictability.
Is it inflation linked on a year to year or like a 5-year upward only review type, or how does that work?
Yeah, so the ideal is obviously inflation protected as well. I'd say probably half of our leases are fully index linked, half are probably capped and collared. UK is a very particular market where you have 5-yearly indexes, but in most other markets they're annual. In Germany, you have like threshold based, where when you reach 110% of the index, you index up by 70% of that. So but most of the time it's just annual. So like you say, the inflation protection is a huge part of it as well. Of course, it depends on the lease.
So you wanted to join Blackbrook and get involved with another triple net investment vehicle?
Yeah, it was what I saw was an opportunity to do exactly what I had done at Gramercy, but go in more senior. And I'd had such a good experience at Gramercy, and I'd personally benefited from it and done very well, both from career progression and financially as well. I thought this seems like a great opportunity. And there's one thing just saying, okay, the opportunity sounds good, but actually a lot of it is also people as well. And going back to why I chose to join Gramercy, I really connected with the people. I really respected the people, and I thought they were smart, and I wanted to learn from them. It's the same thing at Blackbrook. Obviously, I knew Gordon from a previous life and really enjoyed working with him, and he's one of the most experienced net lease investors in the world. What he's done, building up WP Carey from where it was to where it got to, building up Gramercy Property Trust from 0 to $8-9 billion. So that was great to be working with him again, but then also Arby, who I didn't know but got to know. Just very impressive individuals, and good rapport, and just seemed like a great culture. So that's what drew me across, as well as kind of the opportunity itself. And then there was this other element of the capital partner, because one thing, having a great idea and having great people, but working in the investment industry, capital is everything. An old boss once told me, if you had to break down investing into its core components, which are fundraising, underwriting, and asset management, selling, 70-80% of it is just capital raising. That's the most important thing. And what Arby and Gordon had done is, they had this idea. They went out and tried to raise a fund. Well, did raise a fund, I guess, but they ended up landing with this single investor, Eldridge, who put up all the money, and they're just an incredibly interesting organization. You mentioned earlier that they're backers of Kane International, who are their main other real estate play globally. But as an organization, it's a private investment vehicle for a very wealthy guy called Todd Bowley. That's all public information, of course. And what they invest in is just everything and anything. But everything from Fortnite video games to music rights to they just bought Chelsea Football Club. In the US, they have the LA Dodgers and the LA Lakers, and just kind of like super all over the place and interesting. And they would obviously sit in our investment committee. So getting exposure to those types of people, whilst there's lots of really smart people in the real estate industry, it's great to have that perspective of, these guys are like, well, why should I invest in real estate when I can buy Indian government bonds or like, Bruce Springsteen music rights? Because these are all yield plays at the end of the day. And so it's having that kind of, I guess, like universal view I saw as like, well, first of all, I thought they were a great capital partner to have, but also it would give me that perspective that I probably needed and didn't have at that point.
You're not sat on the board of the Chelsea transfer window, are you? And they're just sticking in all those dodgy new transfers.
Yeah, I actually have nothing to do with that, funnily enough. I did get to go to a couple of games, which was fun, but actually not a football fan, so it's kind of wasted on me.
So tell me about Blackbrook today then. What have you got under management? Talk to me about your team and your plans as well.
Yeah, so maybe the team first. So when I joined, there were 4 of us. We built up to a team of, God, I haven't actually counted it. So there's 5 of us in the investment team. We have a kind of CFO, CEO type person. We've got 3 in Luxembourg. We've got a property manager, like a fund manager, and like a fund accountant, CEO, of course, chairman, and an office manager. So, gosh, there's like 10, 11.
I guess that's the benefit. Also, the triple net lease is you can have a super lean queue, right?
Exactly. Like, there's not a huge amount of asset management to do, although we've actually started doing some more asset management heavy things, and it's a really scalable business. So between us 5 in the investment team, we could probably get out the door, easily 300 mil a year, hopefully 500 mil a year, and in a good year, closer to maybe even $1 billion. Depends. I mean, it depends what deals come across your desk, right? I can't be doing 50 deals a year probably, so requires a couple of chunky ones, but you can get there. And once you fire them, it doesn't require a huge amount of bar time as an investment team. So in terms of what we have gone on and bought, so we're sitting around about €1 billion of AUM today. Half of that is standing assets, stabilized. Half of that is development portfolio. Talking about the whole net lease thesis, we come at it from a more real estate, if net lease is a combination of credit and real estate, and it's a balance of the two, we're probably taking more of a centrist approach. So, my background at Gramercy is probably more on the real estate side, whilst when I joined, it was credit. It had ultimately, and it was marketing itself as a net lease fund. What it had turned into is a fully fledged logistics fund. I think that was mostly capital driven, because when we came to launch the 3rd fund, people just wanted to invest into logistics, and we had that experience through what we had bought. I'll say it's kind of by chance, kind of not by chance, but like following yield. And so that's really where I built the most of my experience. And, we wanted to create mission critical real estate because we wanted, income continuity and stability. And so there's this huge tailwind in the logistics sector. And so we thought, well, why don't we just build the yield rather than buy the yield? Because things have got quite steamy towards the end of 2021 and into 2022. We just thought the market was getting a bit toppy, and the perception of leasing risk was very, very low. If we could build in, really good core markets, we could attract the type of tenants that we would want to, buy the real estate of, had they been leasing it from the start. So that's what we've gone on and done, and that's where that 500 mil bucket of development pipeline is fully spec across core European countries, and that's what we're doing a lot of right now. Although that's not to say we won't do this kind of traditional net lease stuff as well. It's kind of we kind of just look for one or the other, really.
And so you joined as an investment director, and then you've been promoted to managing director. How's your role changed?
Yeah, I mean, when I joined as a director, I was the only person in the investment team. It was very lean, so I was just it's just a title, isn't it? You're doing the same thing, right? You're, speaking to the brokers, doing the underwriting, writing the memos, doing the site visits, all the due diligence, and then closing, and then moving on. Yeah, I think it's less of title change, more of just team growth. My role now is, I sit across all the teams, all jurisdictions, all assets all strategies that we implement. So I'm more of kind of a manager now than I was actually doing the deals. Just call it a teacher or manager.
Player coach.
Yeah, exactly. Which is, I think for my skill set, certainly something I don't take naturally to, but, I'm certainly, enjoying enjoying the, getting up to speed with it and kind of improving my skill set there.
What's the challenge with the market right now as we sit here in 24th of January 2023? How do you see that?
Yeah, I mean, the question is, what's an appropriate yield? Ultimately, it's all macro, right? So you look at the interest rate environment we're in right now, which is UK base rate at 4.5%, SONIA swaps at 3.5, 3.6. I don't know, it changes every day. In Europe, it's not too far off that, maybe a couple hundred basis points off. Euribor swaps at 2.5. Contextualizing that, Euribor swaps were negative for like, I don't know, 10, 15 years. SONIA was probably ranging between 0 and 1, maybe 1.5%. And if you look at where yields were in other asset classes like bonds, or, I guess you get an applied yield from buying a company, like yields were low. We were in a low interest rate environment. Now suddenly we're in a high interest rate environment. So the feeling is that one must be compensated for that, because why should I buy UK logistics at 5% when I can buy UK triple B minus or double B plus maybe at 9-10%? Like, does that feel like, where would you put your money? Like, and so that's ultimately what is challenging right now, is justifying. Basically us from a fundamental perspective, pricing these assets, looking at all asset classes, coming up with our number, but then the seller's like, no, I need 200 basis points tighter. There's this bid-ask spread that's super wide, and we're here and they're up there, and it's kind of, I don't know, it's a difficult gap to bridge. Now, lots of things can change. I think most people think right now the interest rate environment is transitory. I don't mean transitory in terms of what people are telling us about inflation, which turns out not to be true, but transitory in the sense that I don't think people believe that we're going to remain at 4.5% base rate in the UK. It's kind of a means to an end, which is quelling this inflation. And so the trick is, rather than valuing things off of today being the steady state, is having to have a thesis about what the future looks like. What do we think the long-term interest rate environment looks like, and investing on that basis. And, that spits out a number, and it still seems like there is, a gap between what sellers want and what buyers want. And part of that is also just psychological, because if you put yourself in the shoes of an asset owner and, 12 months ago, you owned this piece of gold, right, that is super rare, and everyone's bashing your door down saying, I want to buy it, I want to buy it, I want to buy it. You bought the gold at, 100, and now it's worth 200, 250. And you're like, okay, I'll think about selling it. But real estate is quite illiquid, right? So it takes you time to prep the data room. By the time you've come to prep and you have to go to your investment committee and get the approval to sell it. And by the time you've done that, people are telling you, oh yeah, I was going to pay you 250, I'll now pay you 100 or 90 or 80. And I think that psychologically, that's very hard for people to get their heads around, like how quickly things have moved. And so there's a bit of a barrier from that perspective. And also the feeling right now is it's kind of pretty, darkest before dawn type scenario right now. Maybe we're kind of moving out of it now. So why sell now unless you have to? The feeling is that tomorrow will be better times. And I fully believe that. So most people are just sitting on things.
And when is tomorrow? Is that, I guess that's the $1 million or $1 billion question.
Well, yeah, I mean, I'm no economist, so I'm not even going to attempt to answer that question. I mean, you can look at the forward curves for, the swap rates, and it seems like things start to normalize over the course of 2-3 years. If you look at the US, which is always the leading, because basically the US exports the interest rate environment because the dollar is the hegemony or whatever of the US. It's the prime, you buy oil in dollars, you buy lots of commodities in dollars, like they basically export inflation through that. And they're talking about potentially an easing off of the interest rate hikes at the end of this year, or at least no more hikes at the end of this year, potentially starting to come off over the course of next year. It really just depends on when inflation stops and if a recession happens effectively.
Can you talk to me about how you've gone around assembling a high-performing team? Because you've got a very diverse team in terms of gender, background, no doubt neurological experience as well. But you've got a kind of a preference for maybe certain universities or types of degrees. Can you give me a bit of an insight into your rationale behind that?
Yeah, I mean, it maybe just comes from personal experience in that, there's smart people that do all types of degrees, come from all different backgrounds. A hiring decision, I think, is very high risk because if you think about like the hiring process, you meet that person 3, 4, or 5 times, you maybe give them like some sort of like case study, maybe a modeling test, but like you get very, very little exposure to that person. And so you then have to start relying on other pieces of evidence that, give you clues about like how probable is it that that person will be a good fit. So that's why, for example, you screen for using universities. That's why you screen using grades and career backgrounds, things like that. Because it's not to say that if you don't have those things, you're not a good fit. It's just me admitting that, it's a hard, like I say, I can't do doing a full due diligence of the person would be hiring for a year and seeing how they do. But you can't do that. So you have to admit there's chance in it. And so I'm trying to remove as much chance from it as possible, select from a pool that has a higher probability of people who work for my organization. And what I've found in previous organizations I've worked at is that I think candidates from a STEM background have been taught a certain, problem solving framework, because the degree is just solving problems, right? So coming at it from like a very logical, thoughtful, step-based process. And that's always just worked quite well. I know the way that my mind works. I know the way I was educated to look at a problem. And so I trust that that works. There's obviously different ways to skin a cat, but I think that works. And so that's just what we've decided to do. And so the backgrounds of our people, our team, two did chemistry, one did biochemistry. Obviously, I did engineering. One actually went to American University and did kind of like business-based studies. So there are exceptions to the rule, but generally speaking, that's what we look for.
No, it's great. So from a taking a step back, what are you most excited about right now as you look out to 2023?
I think, with risk also comes opportunity as well. The two come hand in hand. You've got to take risk to make return. There's, otherwise there would be no return because everyone will pile into the trade. And if you look at, vintage, fund vintages that have done incredibly well, typically it's because they were buying assets at distressed prices at low points of the cycle. So for me, the excitement is, for the first time in my career, living through a market dip. I started my career back in 2012, but really kind of investing in 2014, 15. I've only ever seen asset prices go up. And whilst I've benefited from that because I bought, halfway on the way up and then sold it 3/4 on the way up or whatever, now I'm getting the opportunity to kind of catch it on the way down. And, a big part of that is kind of timing it and making sure you are getting the right deal and investing at the appropriate time. But yeah, I think it's a huge opportunity for people in the sector today, and people shouldn't be scared. What's the term? Be greedy when people are fearful.
Fearful when others are greedy.
Yeah, exactly.
So someone who's in their early 30s, who's achieved a hell of a lot, do you ever feel that age has been a barrier to your success?
I don't think it's a barrier, because I think, I've kind of gone and done everything I wanted to do at this point. Obviously, there's more I want to do, but I'm very happy with where I've got to today. I think real estate as a sector, and probably finance more broadly, is a sector that rewards grey hairs on the head. So I'm very aware that when I go into meetings, this is something I was super aware of when I was younger as well, my first days at Gramercy, is you're going in to meet people who are 40, 50, 60 years old. They've been doing this their whole life, and I think you have to kind of be that much better to overcome, like, effectively the way you look, which is looking young. And so, I think it has been maybe tough. I can't complain, but it's definitely tougher being younger. But also equally, I've been given these amazing opportunities. So
You just had to outwork it. And
yeah, I think so. Or maybe it's less about outworking it, but more of like a point on empathy. Because oftentimes you're going there just to have a meeting to get something out of someone, like convince someone to give you a deal, or you're interviewing management to get information on their company, and you have your whole question list, but it's about getting them to like you and want to give you the information or want to work with you. So it's probably more the empathy side of things that has been really important to kind of overcome that age gap, as it were.
What advice would you give someone who wants to get into the real estate space now?
It's a good question. I mean, my path in has been so kind of, like I say, by chance, and a bit kind of random. But I think if you wanted to get into it, I think firstly you have to understand what it really is. And the one thing I didn't do was understand what it really is, but I was just lucky. And you can either come at it as like you can focus on people and follow and target organizations with the right people, which worked as a strategy for me, or you can target specifically what the organization is doing and pay less attention to the people. And if you want to know what the organization is doing, I mean, these companies are so opaque. and they use these terms that are confusing, and they're probably purposely confusing as well. Kind of high barrier. I think you just got to meet people. Like, first of all, LinkedIn is such an amazing tool, and I don't use it enough. But what I do get is people reaching out to me saying, "Hey, I'm a student, or I'm in, or whatever, and I want to learn more about your industry." They're not necessarily saying I want to get to real estate. It's like, I'm thinking about what I'm doing. I don't know what you do, and can I pick your brain? I'm like, I never ever say no. Because I think if I was in their position and thinking about how confused I was looking at the websites of these companies, I would always give half an hour. I would always be so grateful someone gave me half an hour of their time. So I think first and foremost, I think you just have to meet people and understand what they do to understand what's out there and what suits your skill set and what piques your interest, and not being afraid to really just kind of network. And obviously if people say no, but who cares? Like, just kind of throw 100 darts at the wall and see what sticks, and you'll be better for it. But also when you meet those people, I think you'll kind of, opportunities will come out of that. Like, showing that initiative, I think, really stands out. Whilst I say lots of people do reach out, not that many in the context of like people who are looking for jobs. So I think it will all kind of work out once you just start networking and working that piece out. The rest will follow.
Yeah, sure. Do you think real estate as an asset class is complex enough to intellectually stimulate you for the long term?
Yeah, I mean, there's always different aspects to it, and the great thing about the net lease aspect is it's not always about the real estate. So oftentimes I'll give you an example. We're looking at a deal right now, sale leaseback, multi-jurisdiction, 300 or so million euros. It's a tier one automotive supplier, and so there it's all, and the real estate is challenging, right? Like, these assets were vacant, you would be up Thingy Creek with no paddle. So there it's all about really kind of rolling up your sleeves and doing a full kind of credit underwrite, and every business is different. So like every day, every week, I get to kind of get into the bones of different businesses and understand how they tick. So I think from that perspective, it can be, whilst there's no diversity in terms of real estate day in, day out, there's diversity in the companies and the sectors, and you can really get into the detail of it and speak to people who manage these companies, build these companies, and that's incredibly inspiring. So I don't think that ever gets old. And also, like, the real estate element is, I like buildings. Like, it's very relevant to our lives. Everyone always says it, but like, we live in real estate. Real estate is all very physical. I'm also an engineer. I like the structural elements of things, like the technical elements. So yeah, I think, look, I'm not bored yet.
Where does ESG fit into real estate or Blackbrook Capital? Because I think you touched on earlier in our conversation, ESG and maybe a little bit more asset management coming into the fray as well. Can you just expand on that?
Yeah, I mean, ESG is like becoming more and more relevant by the day. Especially, I mean, obviously there's the E, the S, and the G. I think we focus on all those things at Blackbrook, but primarily through the real estate, it's the E element, the environmental element, and the physical footprint of real estate globally. One of the biggest emitters of carbon and other greenhouse gases, and so everything that we can do as a large scale landlord to improve the efficiency of our buildings, or if we're building the best buildings we can, we're kind of doing our bit for the future. Now, it also just so happens to be that you can make return off of that, which is fantastic. So anything from putting solar panels on the roof of your building, we've got wind turbine on our assets, rainwater harvesting, looking at the way the buildings are buildings, doing them in a carbon neutral way, like carbon neutral construction. All these things actually, funnily enough, result in better returns through rental premium, through yield premium, or I guess yield discounts, would you say? I always get confused with that one. But yeah, it can kind of, it's like, you do good and you make money. So like, it's perfect.
As we draw towards the end of this conversation, I ask everyone the question: if I were to give you £500 million of equity, who are the people, what property, and which place would you look to deploy that capital?
I think maybe doing property first. We look at all asset classes. We're asset class agnostic, but and I think about it a lot because we have to think about it a lot. I keep coming back to logistics still being my highest conviction sector of all the sectors in real estate. And look, whilst prices have certainly come off a long way, I think there's still a lot of return to be had. If everything comes down to supply and demand, effectively putting kind of yield and valuation to one side, from the demand perspective, the structural tailwinds remain are as strong as ever. You have e-commerce, which massively spiked over COVID because of necessity, but, has stepped down as a little bit as retail reopened again. But I think that, that trend is, solely going one direction, which is up. You've got a new generation of kids coming through, and you look at the way that they interact with the world, the way they buy product, it's just completely different to the way that my parents interact with the world. And so I think even if you don't get older people taking up on the internet, which I think actually they will, just through the passing of time and the changing of habits, the internet's going to take over as the primary mode of consumption. So you have that element, but then you also have, globalization kind of going a bit into reverse, before we had this kind of global free trade scheme where the Chinas and the Russias of the world where everyone was friendly, we do business with anyone. Obviously that's now gone into reverse. And so, you have this nearshoring, onshoring, which requires a lot more manufacturing closer to home. So you have a couple of these trends which are really underpinning demand right now, even in the face of a recession where consumption drops. People still need to take space for these reasons, and maybe not in the near term, but over the medium to long term, I think demand will remain robust. And supply is you just can't build these things. It's not a popular asset class with governments and municipalities. They're ugly. It's like not in my backyard. Emissions, noisy, and they're typically located in places where there's alternative uses that are competing. Like housing is a massive short supply in these locations as well, and it's much more popular for governments to support housing, which the voting population actually cares about, as opposed to logistics. So I think you have like this structural supply demand imbalance that just is not going away anytime in the near future. There's no vacancy, and so I think it's just going one way, right? We've hit a blip, but I think over the medium to long term, and we are long-term investors. We're not a 5-year fund or a 7-year fund. We are an evergreen fund. That's the crucial bit. I think over the long term, I think it's still a good bet. And so that's where I'd put my money right now.
And exact place, and then the team or the people that you would bring on the journey or help you deploy it?
Yeah, exact place. With these logistics buildings, there are obviously logistics hotspots for various different reasons. You have the Netherlands, which is effectively the gateway into Europe because they have, a couple of the largest ports in Europe, basically like a giant motorway of the country. You have Germany, which is the industrial heartland. But also, logistics is now shifting towards consumption centers as well. It used to be, more about where product was manufactured and delivered to. Now it's about where they're ultimately consumed. So you have like last mile formats, things like that. So any kind of major population centers in Europe are typically are probably going to be fine from that perspective. And
people, obviously the Blackbrook team, but is there anyone that you look at across the market or that you've worked with that you would get on board to help you with that?
Yeah, I have huge respect for the, the guys I used to work with at Gramercy, Clarion. Like I say, it's where I cut my teeth, and it's where I learned the majority of my trade. And why I went to work there in the first place is because I think they're fantastic, smart people, and I think they're a safe pair of hands. And I would happily give them, not to kind of big up my competition, but
get them on board to help you.
Yeah, of course.
Well, Jon, thank you so much for coming in today and imparting a little bit about your career journey and some wisdom on the market as you see it. So thank you so much.
My pleasure.
Cool. Have a good one. Thanks for listening to this episode of the People, Property, Place podcast. If you found it insightful, feel free to share it with a friend or colleague, subscribe, give us a rating, like or comment. It helps tremendously. It'd be great to hear from you on LinkedIn. I'm super open-minded to recommendations of which guests you think we should get on the podcast or areas of the market that we should explore further. So do drop me a message. The People, Property, Place podcast is powered by Rockborn. The team recruit experienced talent for real estate private equity firms, investment managers, REITs, property companies and advisory firms across the investment, asset management, development, fund management, ESG, cap markets, investor relations and general practice space. So if you're considering your career options at the moment or looking to attract top talent to come and work for you, head over to the website www.rockborn.com where you can find a wealth of resource to aid your search. Have a great day wherever you are, and I look forward to catching you next time.